Well, hello and welcome to this Professional Advisor webinar presented in association with IRESS, where we're going to be discussing the increasingly important issue of retaining clients and their wealth across the generations. I'm Julian Marr, Editor Professional Advisor, and today I'm joined by Colin Nelson, Market Proposition Development at St James's Place, Mark Loosemore, Executive General Manager Wealth at IRESS, and Chris Davies, Managing Director at Engage Insight. Hello, gentlemen.
Hello.
Hello. Good morning.
Let's set the scene. What have you seen in the ways wealth is being passed down through the generations? What sort of developments, evolution, changes? Should we start, Mark?
Probably the first place to start is I think the size of the opportunity is probably bigger than it's ever been before. So I think we've got a generation at the older end where they have greater wealth than perhaps has happened before, particularly for a wider range, and that's meant that this is now touching not just your high-end clients, but a much wider range of people. And then at the younger generations, I think we've got a world where maybe they're more in need of support because of this intergenerational fairness issue with, I think there's a tipping point which is June this year, with people of 49 June this year, and I only know because I'm 49 June this year, are going to be worse off than their parents were. So we have this group of younger people that need help. They don't have the pensions benefits that their parents had, and then a group of people with the assets to transfer across. So I think it's a really big opportunity.
St James's Place at the coalface?
Well, I think the interesting thing for us is that typically people have waited until death, for want of
just before, surely.
The inheritance has basically been the way that the wealth has been passed down through generations. And awareness of the, if you like, the plight of the millennials and the inability to get onto the property ladder and various other things, and the pensions gap, etc. It's driving more people to actually consider the transition of wealth through the generations sooner and whilst they're alive, effectively, which has its own benefits in terms of the psychological well-being of being able to pass down to children and grandchildren.
Okay, Chris.
Yeah, well, I mean, our research, we did a lot of research in these key areas, and what our research is showing across the baby boomers, for example, is that they are very much inherently wedded to their values, in the sense of they are giving a lot of money away to interests like charities or whatever. And of course, what you've got is the product manufacturing issue, where you've got the defined benefit gold-plated schemes, which are now very rare, and of course that money then kind of disappears. And also you've got them, that generation who've bought a lot of annuities in some respects. So you've got the annuity issue, where again that money potentially will disappear upon their death. So you've got all that, and then you've got the millennials really who are coming through for talk about the key issues that you've talked about, because it's true. They are very challenged in what they can and afford to do. But the key issue with that, if they are getting the money coming down to them at any particular stage, they're highly risk adverse. Because what our research again shows is that they've lived through one of the worst market downturns in history. Next to the 1929 crash. So again, they've got all that mental scarring around that they've got to kind of work out who do they deal with, who do they talk to, and what do they do.
I think it's quite interesting that I think the other change very much linked to that is that the difference between generations and the way they behave is greater than it's been in the past. So I think if you look at the baby boomers, there isn't a huge difference from how they behave and how they make decisions, how they interact with financial advice to their parents. But then you look down the other way, and the way that the millennials will actually react to financial advice and behave, and how they communicate and just run their lives is so different from the way the baby boomers were. So we've got this greater disparity in how to interact with them.
Oh, this is going to be a nice simple webinar then. So we basically got behavioural factors, generational factors, attitudinal factors, social factors, macro factors. Yeah, okay. Well, I hope you're not going anywhere for the next 3 or 4 hours, so we should be good. So I think we touched on, we've set the scene, what changes are, why this may be happening. And I think we'll come back, because once we've identified why this is happening, that'll be what advisors, how can they address different areas. We'll get on that in a minute. But are we seeing that knock-on effects then on how the next generation, whether they're deciding to go with their parents, wealth managers, or whether they're increasingly looking elsewhere for advice? I mean, how are we seeing again that they...
I think it's interesting as to whether or not the millennials have been engaged by the wealth manager in the first instance, because a lot of wealth managers will focus on their particular clients and their circumstances and not consider the wider family, either the older parents or the younger children. And I think what we're finding is that with our advisors, those that engage on a family basis and actually start to talk sooner to these millennials than later are actually retaining them, or actually not necessarily retaining them as clients, but retaining their interest and their awareness of the wealth management advice which is actually available to them. And it may be that their circumstances are such they're not going to engage at this point in time, but in the future they may well do so. And I think that's what we're seeing.
And I think that's right. I think the only thing to add to that, though, is that you've got to engage them with a proposition that is relevant for them. Absolutely. Because they are different. And you know, I look back to similar industries like banking. When I left home and I went to university, I went with the same bank that my parents went. My grandfather went. My grandfather was a bank manager at Barclays, so the whole family was with Barclays. When I started work, I didn't want to go to the high street to branch, and the new bank that came out then was First Direct, and it did things in different ways, and it was perfect for me. Now my parents wouldn't go there because they wanted to go in and see someone, they wanted a stamp in their paying in book, but my needs were different, so I absolutely wanted something that was 24 hours 7 available to me on the phone. And I think if you don't give the next generation something in the way that they want to interact with you, it doesn't matter what the parents did, you'll drift away from that over time.
I completely agree with that. And the interesting thing is there's two elements. There's the product set, if you like, which is available, but there's also the servicing proposition, the way these people like to be communicated with, the way they want to interact with their advisor is going to be different from their parents and their grandparents. And actually, as a wealth management organisation, we have to be cognizant of that and start that evolution, or I think we've already started the evolution, and actually provide a differentiated service, if you like, depending on the generation that you're actually dealing with.
So on that one, Colin, I agree in the sense that what we're finding is there are 5 themes that we know, particularly with the millennials and the baby boomers actually, which is interesting. But there's different take on the themes. So the themes that that they're wanting from the industry is education. They want to be educated. They don't want to be sold to. Particularly with the millennials, they want that, go through that education process, and they value that in more ways than one. Then there's professionalism. So they want to deal with a professional outfit for all the usual reasons, which is trust. So it goes back to your point about dealing with the bank, because your father dealt with the bank. I had the same thing. My father was a bank manager with NatWest Bank, so I went and still am with NatWest Bank. So they then got flexibility. So certainly the millennials want lots of flexibility and agility with their products, and you don't get that much, unfortunately, within a very conservative industry. And so LISA is a good example of that, the lifetime ISA, where they can take something out for their first home purchase, because that's a big challenge for them. You've then got values, which is a big one. So it's matching the values, and what are their values? Well, they're all about experiential stuff. So that's where technology can help. So you've got the new technologies coming through, the new banks like Atom Bank and Starling Bank and all that type of stuff through apps. And they are getting involved in that, because that involves of the wonderfully worded in gamification, and getting them really engaged in that whole process and matching it to their life values. And the final one is influence. They want to have influence on what they're buying into, and they're less binary in their approach. Whereas the baby boomers were finding it's all about, well, I need education planning here, and I want to speak to you there, and retirement planning or trust planning. Whereas they are far more experiential, and they want to have an influence on the product design and the service design you were talking about before.
Well, yeah, okay. Well, you've psychically, I think, what I was going to move on to next is what the next generation will be looking for from a wealth manager, and you've come up with some discussion points there. So let's go. There was experience, there was flexibility, and there was
education, professionalism. Yeah,
there's quite a lot of that.
Flexibility values.
Well, I'll let the other two think about that. As you divide. I will point out this is an interactive session, so we do have a couple of polls, of which I'll publish the first one now. Has your business noticed a change in intergenerational wealth retention? So that is hopefully up now on the, we shall see. There we go. Let's go with that. And hopefully there's now available for you to vote. So there we go. We've now set the terms of debate, what the next generation is looking for. Moving on. So which ones of those would you pick up on?
Well, I think the products that often the younger generation are looking at immediately are often a different product set. Their needs are often at a different stage in their life cycle. So there's a lot about getting on the property ladder that you mentioned earlier on. So you're looking at that mortgages, protection stuff, as well as the investment stuff earlier on. So a lot of it's a lot more transactional. So I think that there's a lot around there. I think there is stuff, though, that maybe that they don't necessarily know that they want, but they probably do need, or maybe they even know that they need it, but they can't afford it, which are things like lifestyle cash flow planning help with that holistic view of where they're going for the rest of their life with their finances. And I wonder if that is a good opportunity to get in some of the intergenerational planning activity, because as part of their parents' planning or their grandparents' planning, they're starting to get involved in that sort of stuff, which taps into the education stuff as well about, you know, how they're going to plan out their lives. And that way we can maybe get them out of the transactional stuff and into thinking about some more long-term issues as well.
I think we're spending a lot of time on the education piece, actually, from an early stage with our corporate social responsibility teams. They're actually educating in schools. It's very, very simplistic around savings, etc., to raise awareness. Because picking up on the point, a large number of millennials, when we first speak to them, don't perceive they need any wealth management because they don't perceive they've got the money for wealth management and to actually benefit from it. Well, actually, they have, but it's sitting within the family pot, not within their own pot. And I think this is where we've come to in a lot of our education events over the last 18 months or so, have been actually getting the family to think as a family and communicate with each other. I know from my own experience with my father, who sadly passed away 2 years ago, but he had his finances in order, but he never shared his finances with anybody, and not the rest of the family. Now, we were lucky. But actually, in this day and age, people are becoming more open. They should talk to each other, and they should, you know, be educated together about this family wealth pot to preserve it.
Yeah, I think you're right on that one, because the other thing as well that we're seeing in the market is, you know, my background is I've been a wealth manager and a financial advisor as well, is that we're actually seeing the millennials really valuing coaching and life coaching, because they're all into wellness and well-being in more ways than one. So what you're now seeing is a trend within the industry, actually, which is great to see, which is a focus more, if you like, on executive coaching and how that can help the journey. And you mentioned cash flow modelling. There's also, don't forget, you know, the poorly named robo-advisors, but the automated advice proposition is important as well, because what iResearch is showing is that cyber advice is crucial now to engage the millennials. They want a blend of, you know, the technology, but they also value face-to-face.
Yeah.
So that's an important point.
But even face-to-face can mean something different to that generation. So I think face-to-face, certainly to my parents' generation, will be someone coming around to see them in the house. And I think millennials will find that quite intrusive and just expect that to be by video.
Yep.
So it doesn't mean that you have to move away from face-to-face, but the technologies that
you use
in the community, you know, is very different.
The technology's there because, I mean, you've got live chat is a classic example. So we call it phone a friend. They want a phone a friend. So where we've seen some robo models being challenged, if you like, is that they haven't got that phone a friend approach. So they haven't, you know, it's just their way, the highway. You go on and invest and you press a button, but actually people need the interactive approach. I mean, that could be online.
Yeah, and we are seeing it increasingly, and I think we're seeing it for two reasons. One is that people just don't want the intrusion of having someone come into their house, and we're seeing certain demographics very keen on that. People that are single, people that
always assuming they have a house.
Assuming they have a house, true. But the other one is time poor people. So, you know, often it can be that they just haven't got the time to travel to someone's house or to let someone, they just want to do it at their desk in the lunch period and do it then.
This attitudinal thing works both ways. It's not just perhaps the next generation who don't think that we haven't got any money, we don't need an advisor. You've got a bunch of advisors going, well, they haven't got any money, we don't need them.
Yeah,
and so how does one break this down? I mean, oddly, I suppose it's the thing. We live in a metaphor and investment for what we're doing. We need to be investing in the future and thinking long term rather than short term. That being so, how do advisors go about adapting their proposition to attract people for the future and thinking, right, well, you may not have any money now, but you're going to someday. Let's get that nailed down straight away.
Well, I think within our organisation, a number of our advisor practices have started to actually structure their practices for succession planning, both of clients and for their own business purposes as well. We have one key practice that springs to mind immediately, have restructured completely to focus on the family. So their offices, yes, they have a boardroom, which is, you know, quite technologically advanced in terms of the way you can present, but also they have a living room environment where a family which is a bit more relaxed can come in and actually just spend time sitting down, have a discussion, talk about various things. And also as well in terms of aligning the type of advisor with the type of client.
Yeah, no,
so in some ways, the younger millennial will not want to sit down with somebody of my age, but actually would be more comfortable sitting down with a younger advisor who's part of the business.
And we're seeing some very much more adventurous IFAs making sure that they recruit like you're saying, at that age group, so that they have the advisors that people can relate to, and then they are more natural and authentic in the way that they're communicating.
We're also seeing a movement in the industry at the moment. I don't know if any of us heard of the next generation planners, but they're that movement who are saying, well, hang on a minute, we want to do things slightly differently. We're younger. We've got a whole new generation to service, and they've got different needs, so we're going to do things slightly differently and align it more in a holistic fashion around this wellness idea. So that's where the coaching is important, that's where the technology is important, because we've just done a whole project with a large wealth management group on their proposition and looking at how they can streamline the proposition. And the big important part about that is, yes, technology is important, but it's also the people are very important as well. So the right people, right place, right skills, and look at their client bank and the next generation that's coming through. So we're encouraging them to do conferences for the families, not just individual clients. And then what are you going to do? How are you going to present that? How are you going to present your proposition? And it's all about a blending of the technology, of the proposition itself, the centralised investment proposition or wealth proposition, and then the people, which is financial advice and financial advising or planning process.
We use the term complementary, so you cannot ignore the technology. But we've seen some advisors actually go, well, I'm not getting involved with the technology, it's not my style. But actually, if you can use the technology to be complementary to the advice you're actually giving, the majority of clients actually understand that they will reach a critical point where they need expertise, which cannot be provided by technology and digitally alone. It needs the expertise and experience of an advisor who understands that complex situation.
Well, I wanted to bring that back actually, but I'll just break off quickly and point out, not only is this interactive in terms of polls, and thank you very much for everyone who's been piling into to the one we have open at the moment, it is also, you do feel free to just type in questions. I've had a couple of questions through, but mostly they've been, is this thing working? But I think we've got all that sorted now, not least because, as I say, there's certainly a lot of people who've sent the polls in, so I'm confident one or two people are watching. So do type in your questions, send them on. I will put them to the panel. In the meantime, because I try not to be too Stone Age or Neanderthal in my outlook, but there is, we don't want to throw the baby out with the bathwater. There are clearly some, I would imagine, some old school advice aspects that we want to keep in the proposition, melding the old and the new. Let's have a focus on that for a little while before we get into the wonderful of the technology. What are the bits that will survive this evolution?
So I think on that, you've got the blend of education and professionalism, those two themes that we talked about. And why is that important? Because at the end of the day, trust is the key to this. And you talk about old school, but there's a lot of really good, financial advisors, financial planners in the industry who are now in their mid to late 50s or whatever, and then doing, or older and doing a great job. And it's like me, when I set out post-university, I went to see my bank manager because my dad had been a bank manager, but also, that's where my trust was. And in more ways than one, if the financial advisor or planner, wealth management group, are doing a great job for the parents, that shouldn't be a natural first port of call for them to go through. So I think that retaining that and making sure that these firms are playing to their strengths, we call it, from a coaching point of view, which is all about that education and professionalism piece, I think is important.
So I don't think we're saying that the technology replaces that face-to-face advice. I think we're saying the face-to-face advice is an important part of that, but can be delivered in complementary way. I mean, you used the phrase about it being complementary and working alongside it. So, you're delivering that advice via video conferencing. It's the same core sensible investment principles, advice principles, cash flow planning principles that you've used before, but you're just delivering it over a different mechanism. And I think that will...
I'll play devil's advocate though, because I do think now what you need is a segmented approach in the business, and you need it from a regulatory point of view. I'm going to say that because we're a RegTech business as well. We have a RegTech platform. So you do need to have that approach where you will have a certain section of your clientele who will effectively actually really value just being dealt with by a D2C robo-advisor at maybe the start of the process or for a part of their pots or whatever. So that's where you've kind of, as a business, got to box it a little bit more cleverly around how you're actually positioning your services to meet those client needs.
And going back to your previous question about what can people do to their proposition and to operate better in this segment, one of the things is understanding your client bank better.
Absolutely.
And I remember when I first joined IRESS, I phoned up some of our clients around the globe to understand how they were using technology. And it was really interesting talking to the ones in Australia and how they were mapping out all of their family groups and their family links and valuing the portfolios on a family basis as well as on an individual basis, and running MI on profitability based on family groups. But they could only do that because they were storing the links within the database and storing the preferences of how they could communicate.
Well, I like this. I mean, looking across other countries and seeing their experiences, are there any others that we'd pick on there? The Australian ones, but they do seem to be sometimes a couple of years ahead of us in the advice front. Is there any other ones we can learn from? I'll throw that open. I just thrown that question in to surprise you.
The big one is America.
Right.
You know, if you look what's going across the pond, if you like, I mean, they are all about technology and enabler tools or whatever from that perspective. But they're also about, the good core face-to-face advice, if you want to call it loosely, which is the live chat or it's the Skyping or it's whatever you're doing with your clients. So from that point of view, they're very much into that blended cyber approach. So the classic example of that is Charles Schwab and what they did. So when the markets went horribly wrong in 08, of course they're all ad valorem, so all the fees come off and all the profitability goes down. So what they did was they focused on life planning, and what they offered was, which certainly the Aussies are very good at this because I worked in Australia for a couple of years, is that they offered a service where they wouldn't talk about product. It would just all be about their life journey and lifestyle financial planning, and write a report accordingly and charge for that report. And that saved their profits margins during that period because they spent a lot of money on that. And then they built the robo-advisor, which distributed a lot of their ETF funds, but that's another issue. But at the end of the day, from that perspective, that's a classic model in America where they've had a blended approach across the traditional approach, a cyber approach, and then the auto approach, and it's worked for them.
Yeah. Okay. The other trend I saw in Australia was the use of video conferencing, which I've talked about a couple of times. That was originally introduced in one segment of Australia that I saw, which was for the remote communities. So, they had people in Perth that didn't want to have to travel all the way out to the mining communities to provide the financial advice, although there were people with a lot of money out in that area. Where it actually ended up getting used, a lot of that technology, there was back in the cities with people not wanting to come down from the 20th floor of a skyscraper to go and walk across the road to see someone else because they were time poor. So that was one of the interesting trends. Technology was driven by one need over there, but actually got adopted for another.
And the great thing is, music to a marketeer's ear is the segmentation piece.
Yeah.
It's actually understanding the different elements of your client base.
Yeah.
Building your propositions accordingly to service them, and that can be from products and service set, it can be communication tools, it can be interaction tools, whatever it might be. But it's actually spending a lot more time understanding what your client base is and what your client base could be in the future, and actually starting to look ahead and actually jump ahead of the curve and say, right, okay, these people are coming through, this is where technology is going, let's adapt accordingly, let's start to look at different ways of doing things.
There's such a wealth of data in this industry, don't we? We should be able to segment our clients.
Yeah.
But it's the old adage, isn't it? It's time on the business versus time in the business. And of course, we're encouraging firms to spend far more time on the business to get it right now for the millennials and the next generation needs, because that's where, if you look at this country alone, there's about £3.5 trillion, which is sitting there with the baby boomers. Where's that going to go? It's got to go somewhere, and a lot of it will come down to money. So you've got to get your proposition right for that. In America, it's I think it's 30 trillion. So dollars. So it's a lot of money that's there that needs to be managed and put to work.
Okay, business need to position themselves. Speaking of, I'm just going to go back to this the poll we've had a very gratifying number of you who just contributed to this. Very roughly, we asked you, has your business noticed a change in intergenerational wealth retention? About 3/5 said no change, but it's very neat here. 1/5 said they'd seen levels reduce. The other one seen levels increase. I don't think that means that we've just seen 1/5 go to the other fifth. But if you look at missing clients, now you know where to go. So we'll shut that one up and throw the other one open. The poll, have you or will you be enhancing your service proposition with a digital aspect to meet changing service expectations? So again, we've got three options there for you to play with. Yes, we've already done so, well ahead of the game. Not yet, but we plan to. Or no, we're not going to be doing this. So that one is now open. Let's see what you think of that. I also see we have a question or two have come through. Got my glasses on because these are very small and a bit long. One of you is going to have to leap in here, since I haven't read to the end of it. It may be Chris, actually. Do you think that the regulator will have to adapt and change industry rules to take into consideration the upcoming digital generation who don't want the current labour-intensive advice process? If so, how do you see that working?
That's
with your
brilliant.
RegTech?
Whoever answered that question,
Is it one of your? I was going to say, is that one of your?
Planted by me,
Yeah.
but thank you. Yeah, that's totally in the RegTech space, and that's where we are. We've built a platform which digitizes compliance, and we're very heavily involved. We're speaking on a regular basis with the RegTech team at the FCA, and they are, to be fair, to credit to them, they are actually working heavily on working on the handbook and how they can make that handbook more accessible and understandable, which is what we do, from that perspective. They're looking at things like chatbots. So we've launched, as of this month, so they tell us, the industry's first artificial intelligence-driven compliance chatbot. And what that is designed to do is allow firms to make more sense of how the rules affect them. And what the chatbot does is interrogates the handbook and the web to give them more resource. So that is an example of what the FCA are looking at from that perspective. Whether they're going to change or can change look, I mean, the issue is that the market's changing, needs are changing, and I think where the regulator has been found wanting, certainly pre-08, was the light touch regulation piece, and they have changed that direction. You only have to see what they're doing at the moment on culture. They had a culture conference yesterday on that. So I think certainly with that perspective, they're going to have to take a look at, and they are doing, as I say, with the technology teams and the fintech teams, looking at how they can encourage firms, which they're doing through their sandbox, how can they encourage firms to come in and innovate and then bring new technologies to meet the new millennial needs?
I think there is a political will at the moment to try and be the leading country in fintech. So I think that is forcing people to try and address some of these issues. So you're right, you've got the Sandbox initiative, you've got things like open banking, you've got some genuine initiatives coming through, pensions dashboard, etc., that are coming through to help in this space. We are trying to change a massive culture, though. So the regulation is so embedded in everything that we do, it's not going to change overnight. But there does seem to be a political will and some tangible activity behind that to try and take us in that direction. Okay.
We mentioned a number of specific technology. I mean, my question was going to be, how important is it for wealth managers to have the right technology in place? Let's just assume you'll say very, 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 and then move on to the next one. How can it help? Let's look at this specific area. We keep saying, yes, technology is going to be great, but let's break up the advice process perhaps and work through where these different technologies can help. Because, robo-advice always gets wheeled in. I don't like that. It's not robot. There are no robots involved. There's no advice. But, AI is obviously a part of this, but let Mark take us through the process. And can you divide up the advice process from a technology specialist point of view?
Sure. So I would start right at the very beginning.
We have only got 10
minutes. Yeah, I know. But we talked about understanding your client bank. So let's start about looking at technology to help you understand your client bank, record all your contacts in digital form, and use that to analyse who you should be communicating with. Then I would move on to the engagement with those people. And I think that can be right at the start of the marketing area. And let's bear in mind that younger generations consume things in very different ways than older generations. So we're talking very clear, bite-sized communications through things like social media, through the web, etc. When you're then actually communicating directly with them, I think that digital becomes more important. So that doesn't have to be that you're doing it through robo-advice, but you need to be communicating, storing information, valuations online, etc. When you enter the advice journey, I think people want to be involved in that directly. So maybe they're doing their fact finds and their initial data capture themselves, entering it online and letting people engage with that, because they're trying to minimise the time of, without being rude in front of the advisor. I think the technology is then helping the actual analysis now, so I think we're driving that through. And then right the way through to when you're then executing on either just producing the financial advice documentation, but then executing on some of the plans. Again, technology is streamlining that. And if you can use that throughout the process, you can actually get a cost-effective proposition that maybe has been out of the reach of some of the younger generations until now as well. So it's actually bringing the financial advice to a wider range of people as well.
So Colin, from the user side?
I think the simplicity, the accessibility, the ability to understand what you receive, feel comfortable, communicated with, educated, is all really important on the technology side. It's actually not misleading clients to think that they can do everything themselves as well, actually helping them understand that when they reach a certain critical point, then the engagement with a wealth manager is a critical part of their lifestyle, life stage journey. And actually then giving them that accessibility. But that still might be through technology, as you say, and some of the options there. I think it's basically listening to what your client base actually wants and adapting accordingly, but not going too far, not overcomplicating things. Because coming back to kind of the regulation and the types of products and services that are offered in the wealth management space, some of them can be pretty complex. And actually can confuse people really quickly.
So I think there's a missing piece in the jigsaw here, which is what we call the middle office. And a big part of that is paraplanning. And if you look at the whole movement in this country regarding paraplanning, and we did a whole piece on GDPR for a powwow. It's called Paraplanners Powwow, which is run by Richard Allen, who's done a great deal of work in paraplanning and enhancing it in this country. And you think about other industries like legal, paralegals. You think about medicals like paramedics. They have such an important role, and so do the paraplanners in this. And what you're finding is it's those firms who can actually uplift the role of paraplanners and showcase the job that they do for their clients, who are then showcasing value. Because the biggest part is that we find that these advisor firms and wealth managers miss a trick, if you like, is they charge in the wrong places. They actually don't charge where clients are valuing. So we've got a map we've mapped out in one of our research papers, which shows they're all charging in the research and in the writing of the plan and that type. It's all very transactional. Where clients are really valuing, and this is the millennials too, mainly, they're really valuing the relationship and the ongoing relationship and what the paraplanners are doing for them and all that type of stuff. So charge there, and clients will pay where they value. So that's an interesting piece, we thought. So that middle office piece, which is also empowered by technology, because that empowers paraplanning as well as the rest of it, is very important.
That's very interesting. I mean, maybe moves on to it. I was going to have a two-part question. What have you noticed wealth managers doing well to retain next generation wealth, and what mistakes are they making? So let's start with the positives. What do we see people doing well? Wealth managers, advisors. What are they doing well to retain the next generation? I'll get some top tips going here. What are you doing well at St James's Place? All modesty aside.
I think the key element is the engagement with the whole family, is the education piece across the family, making wealth management an inclusive thing for the family to experience together. I think in the first instance, actually, interestingly, helping the silent generation and the baby boomers to understand the situation and accept the plight of the millennials, and actually at the same time helping them understand their own circumstances. The fact that they're going to live longer in retirement, they are going to probably require medical care or assistance because they are living longer at some point, so that needs to be taken into account. And actually then the benefits of helping the other generation. So actually the education piece is, I think, something that we're starting to do really quite well and engage with the different generations. I think in some cases it's those people who close their eyes to that fact and say, okay, well, I've got a client bank and this is where all the wealth is and this is where I'm actually going to focus. And that's not really a succession planning long-term type view to be taking. It's something we're trying to help our advisors get over and move into this broader generational view.
Okay, that's the inside view. And from your...
well, we were talking earlier on, and I was quite struck by some of the things you were saying about how you're looking at your communication strategy, so you choose different venues for your seminars, something that will appeal to wider when you lay the seminars out in different ways, and interact with the audience in different ways. So I think that's important. I think we are seeing some people also recognise that sometimes brands don't necessarily go between generations. So, you know, you've got people like Aviva that have a very strong brand and have digital propositions, but are investing in Wealthify to communicate to a different generation as well. So I've seen some interesting things like that. And the final bit is just seeing people beginning to try and understand the interactions between their different clients and their families and mapping that out.
So I go back to our 5 key areas, which are themes really. So education, we talked about, you know, that's crucial. And it's educating the millennials certainly in areas that they want to be educated in. So we're seeing a lot of good work that's been done through conferencing, for example. So the PFS had an interesting one last year where they had a festival of financial planning, which we attended, which was great because they had, you know, it wasn't just about the industry. They had Tesla there. They had other industries there, other industry speakers there, which was good to see. You've then got, you know, the professionalism piece, which is trust, and the professionalism piece isn't just about the trusted brand, if you like, you know, from that perspective. It's also about an experiential viewpoint about, you know, people are really valuing the experience they get, because to your point, Colin, about, you know, how you're then tailoring your services to meet their needs. Flexibility, as I say, is all about, can I get flexibility in what I'm doing? I don't just want a pension for 25 or 30 years or whatever. What else can you offer me for my needs now? Because the saliency is a big key area. Values, we talked about really where it's about their wellness and health and well-being, and, you know, a lot of them are non-drinkers. You know, a lot of them are going down the vegan route, you know, so they're not going to want investments in McDonald's. So, you know, that type of stuff is important as well, getting the propositioning right to meet their values and the professional management of the portfolios right. And finally, but not least, is the influence, giving them, letting them feel that they're involved in the process, that they've got control, because that, again, is important. Because the problem with a lot of baby boomers is that in many ways they don't feel they've had a voice. You know, it's either annuity or DB pension or whatever. It's all very binary. It's not that simple now.
Can I just carry on, just to pick up on the venue thing? The interesting thing is just to share with the audience, you know, is the seminar dead? Well, no, I don't think it is, because the format of the seminar that we ran last week was, firstly, the invitees were all children of clients, so we call it a next-gen event. There were 3 bite-sized presentational chunks. The first chunk was given by a couple of our graduates, just outlining their situation as it stands at the moment. The second segment was a cut between a presenter and video. And the third segment was basically, we would normally do a Q&A. We did a discussion forum. We pulled chairs into a circle and effectively sat amongst the audience and chatted to them about the prevailing conditions and intergen, you know, family wealth planning, etc. And the engagement was absolutely fantastic. But we would never have got away with somebody standing up for 45 minutes to an hour espousing about investments and various other things. So,
So a bit of flexibility on your own part there as well during the education experience, fitting all together. I see. It's rules for life now. So on the downside, then, what, just maybe pick out a common mistake each that you're seeing the wealth managers go, and you know, actually that's not the way to be doing this. Anything from your side, Colin?
I suppose really it's the advisor who believes that it's a one-size-fits-all in terms of the product set and service set, and that a broad range of clients will want exactly the same thing and to be serviced in the same way. There has to be flexibility in this day and age.
I'd say getting some of the basic infrastructure wrong. So I've seen people say we're going to go digital, and going digital, but haven't actually got the accurate data back in the office about their clients, so they're just exposing their weaknesses directly out to the client. So you're going to go do things like go digital, make sure you have the correct data on your clients that you're then exposing.
Yeah, and from us, I'll bring those two together really. It's the first rule I was told when I joined the industry in 1990, which was never assume. It makes an ass of you and me. And it's true, because unfortunately, you know, you're still seeing some car crashes in the industry, if you like, and a lot of it is down to is biases. Well, it's the way we do things around here, and we're not going to change. Or it's, you know, well, if we just employ this technology and press the button, it's magic, isn't it? It's just going to work. No, there needs to be a lot of hard work done in before that, which, you know, where we help firms with, which is really understanding, getting strategic about it, sitting down, working out beforehand how it's going to work, time on the business, and then starting to employ the right strategies going forward, which involves technology, which involves service propositions and the rest of it.
I think Thank you. Well, I've got a couple of questions. I'm just going to wind things up. Conscious about the time here, but I've closed down this other poll. Thank you. Exactly the same number of people, and a very gratifying number of people. I'm going to put submitting their poll. This was: will you be enhancing your service proposition with a digital aspect to meet changing service expectations? In effect, have we persuaded you on this thing? Well, not doing too badly. What have we got? Yep, there's not a very keen view. 31% of you said that you've already done so. Well done to you. 63% on my procrastination group. Not yet, but we plan to, so that's very decent. 7 no, adamantly. We will not be doing this. Now, thank you again for participating in that. On a totally unconnected point then, can businesses that do not digitalise their service proposition hope to retain intergenerational wealth? I mean, is there more than a one-word answer from your point of view, or?
It depends.
Oh, 2-word answer. Okay.
It depends. Is that enough for you?
Well, they don't have to be that quick. As we do. I mean,
I think they can. I think they can.
Yeah.
I think there's still a role. I think it becomes harder because I think the cost of doing business is increased, so therefore it's harder to get a proposition at a cost point that the younger generations will wear, and B, there's going to be a limited audience that will take that up. But clearly there are niches that people will succeed in, and if you're offering good quality financial advice, you will be able to do that through other channels. I think it's just harder.
Okay. Well, just quite an interesting question in which doubles up. I've been saving one of these questions for the final or singing or dancing finale, but now one has come in, and it's maybe I think what we got 2 questions which coming from towards the same point, but one from a product point of view and one from a service point of view. So try and hold both of these in your head if you can, and feel free to answer either one or both. On the service side, what's the single most effective action that you've seen taken that has worked in retaining clients and the wealth across I'll stick with this. I'll stick with service first then. What is the single most effective action that you've seen taken that has worked in retaining clients and their wealth across generations? So maybe a one-sentence answer, or does...
I'll go first on that one. Surveys, surveying client needs. The very few firms that we've come across actually do it on an active basis. And we'd recommend doing a survey at least once a quarter across your clients, depending on obviously the size of the firm. Yeah. So you're understanding what the clients want and what they're experiencing and their understanding.
Okay, great.
I'd say probably recruiting the younger advisor that can have that authentic conversation and offering to the younger generation.
I think with our advisors, I think those who actually share with their clients the fact that they're moving to an intergenerational position to service families and actually articulating that simply and effectively immediately engages and makes people think about it and to engage with that advice.
Yeah. Right.
That's quite interesting because actually that's 3 different aspects of communication all across. It's getting okay, and then finally, this again I think is more from the product side, but it's quite interesting. It's very interesting. We love all your questions. Thank you very much for sending them in. We want to produce a streamlined and cost-effective solution for younger clients who don't have money now but may have in the future. But we cannot see a way now without making a financial loss to the business, even when using technology. Have any of you found a way to do this while still satisfying the regulator?
Yeah.
Oh, hello.
Videos. So video for the younger generation, they love videos. And they like to see your face, they like to hear you talk, they like to engage with someone who's a real live individual. So you can put out a suite of videos on the educational piece about what financial planning means, or what holistic lifestyle planning means, or what tax planning means. So from that perspective, it's an educational process where you're not selling or products or whatever, but you're actually putting a suite of videos which are highly educational, which costs nothing to do, particularly if you use a smartphone. Yeah. You put it on your website and away you go, or a YouTube channel, away you go.
There was a brilliant example of that, which was Meaningful Money.
Yep.
And people have seen that, Pete Matthews from Meaningful Money. And I think he's moved more to sort of doing them audio so that people can listen to them in the car. Podcasts and stuff now. But he used to go around different places in Cornwall and he would just be parked up by the beach in his car and film himself talking about a subject that would be relevant to his audience. And they were really engaging videos, and you would just look at them because they were short and sharp, they were educational, and they weren't boring. So I think video is a great way. I do also think, coming back to the question, the other one, I don't know whether there's more ways of tapping into the parents' advice journey to include the children within that. So we're talking about cash flow planning, but maybe almost you can do lighter touch cash flow planning, maybe as part of the as a family service, which is almost funded by the older generation to pull the younger generation in. So that would be the other.
I think both of those, actually. I mean, our graduates are working in our corporate social responsibility teams and putting together a YouTube channel purely for education purposes, younger people communicating with younger people. I think the key element is that you've got to consider future-proofing your business. It may be that the youngers, the millennials, etc., are, for want of a better word, a lost leader for the business. But it's engaging with them now so that in the future they become clients. And then obviously the advice can be provided, etc., and then the business may benefit from that. But in the short term, it is about taking a future-proofing stance with the younger generations.
Thank you so much. I'm going to wind it up there because we're bang on time, or what I was planning to be time. So thank you very much, gentlemen. I apologise, we've had a number of questions. I apologise that we couldn't fit them all in, but I hope you feel this was all worthwhile. Thank you very much to our guests, to Chris, to Mark, and to Colin. Thank you very much for watching. I trust you found a very useful use of your time. If you have, and you think it's useful to pass it on to some of your colleagues, please do email them the link. That would be fantastic. Otherwise, we'll have you another time. Thank you very much for watching.